Welcome. Today we're breaking down the Income Tax Act India's rulebook for taxing income from individuals and companies. It defines what counts as income, what expenses you can deduct, and how much tax you owe. Taxes fund public services like roads, schools, and hospitals, so understanding the basics matters for everyone, not just accountants. The Act is updated every year to keep up with the economy. One key section, 115JA, sets rules for how companies calculate taxable profits, especially through something called Minimum Alternate Tax, or MAT. MAT ensures even profitable companies pay a minimum tax, closing loopholes from clever accounting. Today, we'll focus on how MAT treats provision for doubtful debts, money set aside for customers who might not pay. Should this provision be part of a company's taxable profit? A recent court case has clarified this, and we'll unpack it step by step. Let's get started. Before diving into the law, let's clarify two key accounting terms: provision and reserve. A provision is money set aside from profits to cover a likely expense, like bad debts, before calculating net profit. For example, if a company expects some customers won't pay, it creates a provision for doubtful debts. Provisions are necessary business expenses for specific anticipated losses. In contrast, a reserve is money set aside after profits are calculated, for general purposes or future needs, not for a specific liability. Think of a provision as setting aside money for a bill you know is coming, while a reserve is like saving for a rainy day. The distinction matters. Provisions reflect real business risks, while reserves are about financial strength. This difference is at the heart of the court's decision on MAT. Understanding it will help us see why the treatment of doubtful debts is so important. Let's move on to Section 115JA itself. Section 115JA introduced minimum alternate tax to ensure all profitable companies pay at least some tax, even if they use deductions to reduce their liability. If a company's tax as per normal rules is less than a set percentage of its book profit, then tax is charged on the book profit instead. Book profit is the net profit shown in the company's profit and loss account with certain adjustments. One adjustment, adding back any amount carried to any reserves. The confusion: is a provision for doubtful debts a reserve that should be added back? The tax department said yes, arguing it's just money set aside for the future. Companies disagreed, saying provisions are real business expenses, not reserves. This disagreement led to legal battles, eventually reaching the courts. The core issue: does a provision for doubtful debts count as a reserve under Section 115JA? Let's see how the courts resolved this. The Bombay High Court heard a case where a company's provision for doubtful debts was added back to its profit by the tax officer, increasing its tax bill. The officer argued the provision was a reserve, but the company insisted it was a necessary business expense. The company explained that without this provision, its profits would be overstated and misleading. The dispute moved through appeals and tribunals, finally reaching the High Court. The key question: should a provision for doubtful debts be treated as a reserve for MAT purposes? The answer would impact countless companies across India. The court's decision would finally settle the matter. Here's what the judges decided. The High Court examined accounting principles and the law's wording. It confirmed a provision is for a known likely loss like bad debts, while a reserve is a general allocation of profit. A provision for doubtful debts is a calculated estimate, not a random set aside. It reflects a reduction in asset value, not a future liability. The court ruled that provisions for doubtful debts are necessary to show a true and fair financial picture. Simply calling something a provision doesn't make it a reserve. The real nature matters. Since this provision is a charge against profit, not a reserve, it shouldn't be added back for MAT. The court's decision brought clarity and relief to companies. This was a landmark judgment. The Bombay High Court's ruling gives companies legal clarity. Genuine provisions for doubtful debts won't be added back to book profits for MAT. This lowers tax bills and frees up capital for growth, jobs, and innovation. It also means companies can follow standard accounting practices without fear of unfair tax demands. For the economy, healthier companies mean more investment and job creation. The judgment reinforces fair taxation and logical interpretation of the law. It prevents the tax department from taxing amounts that aren't real profits. The key takeaway: a provision is not a reserve. The court's decision is a win for companies and a boost for economic stability. It's a great example of how the judiciary ensures fairness in our tax system. Thanks for watching. Stay informed and empowered.